Hi, everyone. I wasn't sure if I was recording or not. We're now going to look at Chapter 5's two practice problems, 5.1b and I believe it's 5.3b. Let me double check. Yes, 5.3b. So in 5.1b, of course, we will be reviewing all of those journal entries that we looked at together in our lecture. And then 5.3b, we're going to focus on the income statement, that new and improved income statement. So let's take a look. I'm on page 206. Prepare journal entries to record the following merchandising transactions of IKEA, which uses the perpetual inventory system and gross method. It will help to identify each receivable and payable. For example, record the purchase on May 2nd in accounts payable -Havel. Okay. So, and what they mean by the gross method is the method we've learned when it comes to recording discounts. So let's take a look. May 2nd, the company purchased merchandise from Havel Company for $10,000. Credit terms 115, so a 1% discount if paid in 15 days. If they don't pay it in the first 15 days, they have to pay the full amount by the 30th day from May 2nd. FOB shipping point, so IKEA will be responsible for any shipping costs. So the journal entry is to debit merchandise inventory 10,000 and credit accounts payable 10,000. So on the day of purchase, we show the amount in our inventory asset account and show that we owe this money in accounts payable. And there it is, accounts payable -Havel. Immediately on the 4th, the company sold merchandise to Rath Company for $11,000, offering credit terms to the customer of 2% if they paid it in 10 days. If they don't pay it in the first 10 days, they have to pay it by the 60th day from May 4th. FOB shipping point. So Rath, the customer here, is responsible for their shipping costs. The merchandise has a cost to IKEA of $5,600. Remember, when we have a sale, we have a two-pronged journal entry. The first to be record the revenue related to the sale. In this case, we're going to debit accounts receivable because the company sold it on credit, $11,000, and credit sales, $11,000. That's the revenue account. We also have to reduce our inventory account because that inventory is no longer owned by us. We reduce it for its cost to us being IKEA. So credit inventory, debit the expense account, cost of goods sold. On the 5th, pay $250 cash for those freight charges on the purchase of May 2nd. Well, when we are buying inventory and we have to pay for the shipping or freight costs, we debit inventory for those costs and credit cash. So what we're doing here is accumulating all the costs of the inventory in the inventory account, how much we actually paid for the product itself and how much it costs to ship it, because those are all costs of inventory. On the 9th, the company sold merchandise that had cost $2,000 for $2,500 cash. So again, two-pronged journal entry, they're selling. Debit cash, because they're getting the cash immediately for $2,500, that's how much they sold it for. Credit sales, which is the revenue account, $2,500. Increase the cost of goods sold or expense account, $2,000, and credit the inventory account for $2,000, the cost of the inventory they sold. On the 10th, IKEA purchased merchandise from Duke Company for $36.50 under credit terms $210, $215, and $60 FOB destination. So that means Duke paid for the shipping costs. The seller owned them while they were being shipped, so they own them. So they are responsible for the freight. So what does IKEA do? Debit merchandise inventory for the amount $36.50, credit accounts payable Duke to show they owe the money to Duke. Okay, on the 12th, the company returns $650 of the merchandise they just bought on the 10th from Duke. And when they return that, they debit accounts payable. Well, of course they do, because they haven't paid that $36.50 yet they owe to Duke from the 10th. So if they're returning any merchandise, they want to reduce the amount they owe to this supplier by $650. We also credit inventory. When we bought this inventory, we thought we would own it. But since we're returning it, we don't own that anymore. We must credit the inventory account. Remember, this is IKEA returning merchandise they bought. Now, on the 14th, IKEA received the balance due from Rath Company for the invoice dated May 4th. So take a look. Here is the transaction from May 4th. On that day, Rath owed the company $11,000. But remember, IKEA, us, said, hey, Rath, you pay in the first 10 days, we'll give you a 2% discount. Remember, 2/10. Well, they are paying in the first 10 days. So we're going to take the $11,000 times 0.02. That's a $220 sales discount. This is our customer paying us early, the company. So it's a discount on the sale. So how much money will IKEA, us, receive? $11,000 minus the $220, or $10,780. So we will increase cash, $10,780. We have to decrease accounts receivable for the full amount that was owed, $11,000. Rath is satisfying that entire $11,000. We just told them take a discount if you don't pay it all in cash. And we debit that contra revenue account sales discounts. Remember, we're just using that to store all the discounts taken on the sales. That's a revenue contra revenue account, or contra account to the sales. We saw that account balance will decrease sales on the income statement, just like a contra decreases its linked account. The 17th, IKEA, that's us, the company, paid the balance due to Havel within the discount period. So let's take a look. Here was our Havel purchase. We purchased merchandise for 10 grand. Havel said, pay in the first 15 days, IKEA, take a 1% discount. So $10,000 times 0.01 is a $100 discount. So now when it's IKEA taking the discount, it's a purchase discount. So we debit accounts payable for the full $10,000 because it's IKEA paying off a liability. The full $10,000. Debit it, decrease it. Credit cash for the actual amount they are going to pay, $9,900, $10,000 minus $100. The purchase discount decreases the inventory account because we didn't pay $10,000 for that inventory. Since we took advantage of paying our bill early for that inventory, we decrease the inventory account for any purchase discounts. So in one discount, you saw the customer taking advantage of a discount and how the company records it. And in the second one, you saw the company taking advantage of a discount and how it's recorded. Let's look at the 20th. IKEA sold merchandise that cost $1,450 to Tammer Company for $2,800 under credit terms 210 and 60. So a 2% discount if paid in the first 15 days, the full amount if paid in within 60 days. IKEA shipped it FOB shipping point. So that meant the buyer owned it. Tammer owned it when it was being shipped. So IKEA is not responsible for those shipping costs. So what does IKEA do? Remember, they have a two-pronged journal entry whenever they sell. They're going to debit accounts receivable Tammer $2,800 for the amount the customer owes them. They're going to increase their sales account for the revenue. That's the revenue, $2,800, what they charge the customer. They will debit the expense account, cost of goods sold, for the cost of the stuff they sold, $14.50, and reduce or credit the inventory account because they sold that stuff and it cost $14.50. So we take it out of inventory at what it cost us because that's what we put it into inventory at. The 22nd, IKEA gave a price reduction allowance of $300 to Tamar for that merchandise we just sold to them and reduced their accounts receivable. So at some point, Tamar might have called up and said, hey, you guys sent some defective merchandise. Do you want us to send it back or do you want to give us an allowance on the sale? So IKEA said, we'll give you an allowance. So they said, keep the merchandise, Tamar. We'll just reduce your bill by $300. So we debit our contra sales account, sales, returns, and allowances. We just essentially reduce the selling price, right? But we store that reduction in this account. It's a contra revenue, just like sales discounts, and it will reduce sales on the income statement. We just keep track of this separately so that decision makers know, oh, there's how much sales, returns, and allowances happened this period. And we reduce our accounts receivable, Tamar, $300. No inventory is coming back, so nothing happens to the inventory account. The 25th, pay Duke Company the balance due net of the discount. So let's go up to Duke Company. Here it is. Oh, two things happen right in here, remember? First, we bought off Duke for $36.50 and said we owe them $36.50. But then we returned some of the merchandise, so we reduced our accounts payable by $650. So we only owe them $3,000, and we're paying within the discount time, 15 days. So we could take a 2% discount on that $3,000. So 3,000 times 0.02 is $60. So we're going to debit accounts payable Duke $3,000 because we're paying off the entire liability. It's just that Duke said, if you pay it early, send us less cash, take a 2% off the cash amount. So we're going to send cash of $29.40, $3,000 minus $60 purchase discount. Remember, this is a purchase discount because this is IKEA taking advantage of paying their bills early, the amount they owe on the purchases early. So we credit merchandise inventory. We reduce the balance in merchandise inventory for the purchase discounts. $60. 30th. Now the IKEA, us, received the balance from Tamar Company for the invoice dated May 20th. So there's the invoice dated May 20th right there. $2,800 they owed us in accounts receivable. But remember, we reduced how much they owed us by an allowance of $300. So they're only going to be paying $2,500. We sold them under terms $215, and they're paying within the discount terms. So we could take a 2% sales discount on that. It's a sales discount because it's our customer taking a discount on the sale by paying their bill early. So we will credit their accounts receivable account for the full amount. They're satisfying all $2,500 of their bill. However, we are accepting less cash and giving a discount of $50. So we debit our sales discount contra revenue account, and the difference is how much cash Tamar sent us, $24.50, debit cash. The final journal entry, the company IKEA sold merchandise that cost $3,600 to Rath Company for $7,200 under credit terms 210 and 30 FOB shipping point. Well, that's just a normal sale. Debit accounts receivable Rath, $7,200 because the customer owes the money. Credit sales for the amount of the sale, $7,200. Debit the expense account, cost of goods sold, for the cost of the inventory we just sold. Because remember, when we own that inventory, it's an asset to us. But when we sell it, we take it out of the asset category by crediting merchandise inventory and putting it into the expense, because this is a cost of doing business. We had to buy this inventory to make that sale. So when we sell the inventory, it becomes an expense and is debited to cost of goods sold. So that was a great review of our major journal entries related to a merchandiser when they're buying and they're selling. And as you can see, as I said in the lecture, when we lectured, we looked at just purchases. What kind of journal entries are there just when we're purchasing? Okay, what kind of journal entries just when we're selling? Now we have them all mixed up. One journal entry could be a purchase, one could be a sale. So the hard part of this chapter is just remembering, what hat am I wearing right now? Am I the customer? Is it my customer that's involved here, or is it just me? And that's what you really have to stop and focus on. Okay, so 5.3b is our second journal entry, second problem. I'm stuck on journal entries today. So in 5.3b, we have Barclay Company's adjusted trial balance. Remember, adjusted trial balance, doesn't matter what kind of company it is what we make financial statements from. It categorizes the following accounts as selling expenses. So they come right out and tell us: sales salaries, rent expense, selling space, store supplies expense, and advertising. It categorizes the remaining expenses as general and administrative. So beginning merchandise inventory was $37,500. Here's some supplemental information about the merchandise. They tell us how much the purchases were, how much in discounts we took from paying our bills early, how much returns we had of our purchases, and how much we paid in transportation. So the first thing they ask us to do is to compute the company's net sales for the year. And we saw that already. Net sales is the total sales that is currently on our and in our sales account, because we don't adjust our sales for any kind of returns, allowances, or discounts. Then we subtract the sales discounts and the sales returns and allowances. And then that gives us the true amount of sales for the year. So the $332,650 represents all sales. Doesn't matter if they came back, if there was any discounts. Then when we subtract the two contra account balances, now we get a true net sales figure. The next area, although it is listed already, let me see. Okay, I'm sorry. Let me go back to number 2. Compute the company's total cost of merchandise for the year. So what they're asking here is, and just trying to make sure you really understand what's in that inventory account. Okay, so remember, whenever you bought more inventory, you debited $138,500 for the year. Whenever there was a return or a purchase discount, you credited or reduced the inventory account for those amounts. Whenever there was transportation paid, you increased the inventory account. So how much did we spend buying inventory this year? Well, all those numbers netted together are $134,600. Now in 3, prepare a multiple step income statement that includes separate categories for net sales, cost of goods sold, selling expenses, and general and administrative. And there they are. So an income statement starts with your same heading because you're reporting revenues and expenses, gains and losses for a period of time. We start with sales, as we did in step 1, right off our adjusted trial balance. Subtract sales returns and allowances and sales discounts. It doesn't matter what order you put them in. Once you subtract those from sales, you'll have a net sales amount of $306,775. Now subtract your first and major expense of a merchandiser, cost of goods sold, and that's right on your adjusted trial balance. That will give you your gross profit, or the profit just from selling your product. We sold $306,775. The items we sold cost us $115,600. So just from selling the product, $191,175, without looking at any other expenses. Then we subtract our operating expenses. And we have two categories: selling, general, and administrative. And they told us which items, which expenses we're selling. So you just list those and total them and label the total selling expenses. They said any remaining expenses are considered general and administrative. So there is no other expense category here. Okay, so all of our income is operating income. That's it. We don't have any other income. So when we subtract our total expenses after subtotaling each category and getting an overall total, we subtract the $136,000 from gross profit. We get net income. Bottom line, $55,175. Now remember, if we had items such as interest revenue or interest earned, it might be called, or interest expense, we would have an other section. So we wouldn't just stop at net income. That would have been called operating income. And then those other expenses and revenues would have been added and subtracted ultimately to get net income, like our lecture talked about. So this is the income statement you want to focus on for testing purposes. In part 4, they just show us the other income statement you could do called the single step. And the single step says this: take net sales, so that's your only revenue, add up all your expenses, get a total expense amount. So cost of goods sold was $115,600. Now you could list each expense separately here. Okay, what they did is they just took the computations from part 3 up here and said, okay, we know our total selling expenses are $90,350. We know our total general and administrative are $45,650. So just bring those down. Add those three numbers together, which all are expenses, subtract expenses from revenue, and you get the same net income. It's just it doesn't tell as much information as a multiple step does. Here's your gross profit. Here's your overall income. Okay, and that's why, especially with merchandisers, we prefer a multiple step income statement. Okay, so those are our two problems. Please make sure you work through these and understand them and ask any kind of questions you may have.